Hey there, this is David Cox, Senior Portfolio Manager at Financially in Sync at Raymond James in Waterloo, Ontario, Canada. Today on the webinar, Where Do We Investors Stand? It is Friday, May 22nd, 2026. I was in Boston last week, so I was away and glad to be back. So let's start off with our weekly analysis as usual. You can see here for the most part, a little bit of a risk off week for the most part. I mean, a lot of volatility happening still for sure. Silver down on the bottom of the list, crude oil, a lot of the commodities, emerging markets. But again, look, again, lots of green in this table, right? When you really look at it, and again, just a reminder to pause your video player at any more time. Bonds are very, very negative indeed. Yields are rising. We're going to talk more about that. And of course, much, much more. Let's look at commodities versus stocks right now. So here's the last 10 years. And so again, this to me is important. I think what we've got here is a breakout. And I think this is a pullback against. And so again, commodities are rising. And this is not just an oil story. Again, copper has been very strong. Lots of commodities, agricultural commodities are coming on here. So this is, again, the inflationary concern here that, again, there's no choice but to face this as central bankers, because the reality is that the market is aware of what's going on. And here we go, 30-year yields made highs. And we're talking multi-year highs. We're talking a long time here, and this is happening, right? So yields popped up a lot from 2020 for the first few years. They've now been consolidating for the last 2.5 years, and again appear to wanting to go higher. And this is a global phenomenon. This is not related to the US, not related to Canada. It is a global phenomenon. And I think the borrowers beware. Let's look at the market here, and this is the S&P 500. Now, there's a lot of data on here. Again, maybe you want to pause your video player here, but on the top left, this is the year-to-date performance. What I'm trying to show is that out of the 500 stocks in the S&P 500, 280 are positive and 223 are negative. Go to the bottom panel here. We can see I've got the S&P 500 right now in US dollar terms is up 8.8%. There are 322 stocks that are below that, right? So the majority of stocks are below the index return. So people have talked about breadth, and we talked about all kinds of things you might have run into. Oh, the market is being driven by a small group of stocks. Well, this is kind of what we're getting into right here. And then you can see what I've done is taken the deciles, and so you can see the average price performance within each of the deciles. So, the top deciles got an average performance of 89%. So there's some real movers in there. But again, there's lots of baskets here that are down quite considerably as it goes. And so again, let's keep jumping on here. Now, this is at the squinting phase here. We've talked about this. Left side is Canada stocks versus US stocks. And again, this is not an uptrend. Again, we can have moving averages cross over, but the reality is this is always still at the squinting stage. We've still got lower lows. We've still got a lower high. And at this point, it rolled over, and value versus growth on the right side still very clearly appears to be a downtrend. So the theme here is still really not that changed from US equity markets. And so again, whether that continues to develop, whether it continues to take new shape, especially if commodities continue to show strength, we will see. We will not know until we know, and you know how it is. We're going to know from the charts. Okay, so let's go onwards. We're going to look next at if the chart will change. Sorry. We're going to look at a few stocks here that are sitting in the old sync pool. Some of these semiconductor stocks, we've looked at them before. Taiwan Semiconductor made highs here recently in the last couple of weeks. Lam Research on the right side, also the same deal. And in the middle, even though the Toronto market is not nearly as healthy as this particular chart looks, this is the Canadian Value ETF, very strong. And this is actually full of 60% financials, which unlike the US are very strong in Canada, and 30% energy. Let's look at a few other stocks here that I think are kind of by the pullback, if you will. These are weekly charts, right? Southern copper stocks in general have pulled back. I think they're trying to turn upwards here. Hilton Hotels, the discretionary stocks have been very weak here, but again, stocks like Hilton and Marriott have been actually quite strong within. And then again, there was the dip we showed a few weeks ago on Eli Lilly, which is another large cap long-term leader. Now, SpaceX is coming, and it looks like the SpaceX launch, the IPO, will be coming out. Of course, there's been lots of enthusiasm. Lots of these stocks are certainly happening, and lots of hype over the sector for sure. You can see the ARC-X here in terms of its really relative performance versus the industrial sector. And it looks like I've got the charts mislabeled on the bottom, excuse me, but you can see in the top we're essentially consolidating around the prior period of highs. Now, as we go forward again, I'm having chart problems. We've got 4 stocks from the space sector. There's Rocket Labs, very strong uptrend, reported recent earnings that surged. MDA Space, that's a Canadian company. Bottom left, we got AST Space Mobile, and again, a lot of also drone technology and some of these kind of flying, cars, taxis are also kind of included in this whole area. Pretty exciting. Lunar intuitive machines there as well. So again, it's a happening sector, but these are very volatile stocks to say the least. Now I want to talk just a little bit about mental capital and financial capital. This uranium space has been very strong. but I mean, it is volatile and it is very, very challenging from a mental standpoint, at least if I'm speaking for myself. You look on the right side, there is a Sprott uranium miners full of uranium stocks down 33% off the highs in the recent correction. I mean, it's tricky, right? As investors, we always want to go, and I think we should always want to invest in the lower left to the upper right. At the same time, it's not always easy, especially depending on the kind of stocks we get invested in. So some themes, again, they can just, in my opinion, take more mental capital than the financial capital that can be earned from them, at least from an ease perspective. And I think as investors, we need to make these decisions, and we have to be careful with those decisions. They can affect us. A couple of quantum stocks here have come to life. Now on the right side, IonQ, I showed this actually a few weeks ago when it broke out in that green bar. I talked about kind of buying that impulsive bar off the low. That's continued to develop nicely. And on the left side, we've just had this D-Wave Quantum here yesterday post some pretty decent high volume move here. Again, you can see not exactly a base, right? But to me, it's more of what I call the bar, which is showing here that you've got an inflection point from going from selling to buying after these corrections, which were pretty deep, took place. Let's talk about Canadian banks. So I talked about the Canadian financials have been very strong. On the left side is National Bank. On the right side is CIBC. The right one is dual listed, but the yields on these things right now are sitting at like 2.2, 2.3, 2.4 area, and that is not very much yield. I mean, I think historically, bank yields in Canada were sitting more around 4.5. So again, just understand that is not being driven necessarily by an earnings change. It's not. It's being driven by price. So price has gone up so much, pushing the dividend yields down, and essentially right now we've got essentially short-term GIC yields that are sitting above bank yields. So always understand that as we sit here and look at, let's say Canadian banks in this case, they're not yielding very much given that we've got price risk. And now again, price risk obviously doesn't appear to be there because price risk appears to have been going to the upside, but at some point it obviously will change. I think the fundamental people must be having some issues with this because the yield premium is not very sufficient. Now there's this Canadian banks right up on the top of the list as we finish off with Sector Watch. Canadian technology stocks have been very, very poor, but they bounced this week. You can see on the bottom, there's the gold stocks and material stocks for the most part. So this market has just continued to actually consolidate quite nicely. As I showed, though, there's a lot of stocks that are definitely not participating. It's definitely not what I would call an easy market, and it is certainly volatile in the last couple of weeks, to say the least. Please follow me on X. I'm at David Cox RJ, and thanks again for your time this week. This has been David Cox, Portfolio Manager at Financially in Sync in Waterloo, Canada.